Welcome to day 2 of the Modern Investor Summit, where we are at this paradoxical moment in markets. We're close to all-time highs. We've had a strong year across multiple asset classes, but uncertainty and risk still feels like it's at all-time highs as well. Now, Wei Li and the BlackRock Investment Institute have a framework for making sense of all of this, and more importantly, for how you might want to position your portfolio. So let's dive in. Wei Li, welcome to the Finamize Modern Investor Summit.
Thanks for having me, Carl.
Now, let's dive right in, where you've described 2025 as putting a new macro regime into sharper relief. One where we've lost the long-term anchors that have guided investing for who knows how long. So for people watching at home who've been managing their portfolios, assuming inflation maybe 2%, independence of central banks, treasuries are the ultimate safe haven. What's gone wrong? What's just broken?
That's a big question. I think it's not so much that things have gone wrong, as really that things are changing. Things are changing because of the transformations happening around us, because of AI revolution, because of low carbon transition, because of aging population and geopolitical fragmentation, right? So these are the structural, secular changes that are taking place that would likely take us to a different landing spot, rather than the old macro regime where we had, as you said, growth, give or take, been hovering around kind of the long-term growth trend of 2%, and inflation, give or take, slightly below central bank target. It's hard to say that this is definitely where we're heading towards, especially given the constraints that these structural transformations represent, right? If you think about competition for resources, energy, through all this build out that needs to happen, I think we're looking at inflationary environment potentially higher than what we were used to. And then in terms of growth, like if you just aggregate all the CapEx commitment of big hyperscalers, we're talking about huge numbers. We're talking about, like just review of third-party estimates, between $5 to $8 trillion by the end of the decade. To justify this huge amount of investment, growth will have to break out from the long-term 2% trend. So all of that means that the anchor by which we really mean the trend, the average of the past need to be revisited, and portfolio construction process needs to reflect the fact that we're likely going through regime change with different kind of parameters characterizing it.
Okay, so it sounds like a fragile equilibrium there that hopefully investors can rely on, or is it a little bit wait and see?
Well, I don't think anybody can predict long-term macro forecast with high conviction anymore, because nobody really can confidently predict, number one, how much productivity boost AI represent, and also number two, when that would come through, right? And again, this is not our own forecast. We review third-party kind of estimates in terms of productivity boost from AI to the US economy. We're talking about a very, very wide range of estimates, somewhere between 0.1% per annum to 1.5%. That's a huge range, right? So all we can say is that the range of outcomes on the table, it's wider than before, because we're talking about the juxtaposition of all these big changes happening. And as a result, point forecasting, especially over the longer term, is just a little pointless. Like you may have people forecasting with high conviction, but like there's lots of assumptions made behind that forecast.
Yeah, of course.
That's why for our capital market assumption, we're rolling out a scenario-based approach. Like if you believe this, this is the sort of return that you can expect, rather than this is what we expect over that horizon. Because honestly, I don't think anybody can predict with confidence over 5 to 10 year horizon and beyond, given the changes that are happening right now and the decisions that are being made right now.
Okay, got you. I mean, that all sounds very, it's counterintuitive, to the historical paradigm, I'd say, right, where you had more certainty about the long term versus the near term. And instead, I'm reminded, if you've seen Fast and Furious, Dom Toretto, like, he talks about living his life a quarter mile at a time, and we're almost economically living.
Yeah, that's a
one
great
quarter.
analogy. And indeed, what we are experiencing right now is the opposite of what we were used to in the past. Like things could happen in the near term, nobody knows. But over the long term, we know that the gravitational pull of average, be it growth average or be it valuation average, would ultimately mean that you kind of trend towards that mean, right? But mean revert has lost all meaning in this environment of transformation.
Right.
So we have less certainty over the longer term, but paradoxically, we actually have greater certainty over the nearer term because there are things that cannot change too quickly. There are things that are so foundational to the workings of the economy, to the workings of the markets, that actually, if the narrative get too carried away and price in speedy change to something that just by definition cannot change too quickly, that creates tactical opportunities that we try to take advantage of.
Okay, so maybe let's spend some time on those. I mean, let's think about, where are those opportunities to lean against market moves? You mentioned those sort of scenarios in terms of how you're thinking about the longer term, but right now, where's the market getting the narrative wrong? How would you position against that?
Well, I can give a example kind of that was very telling of the whole of 2025, and I can also kind of look ahead and say this is where we see opportunities. So if you think about kind of immediately after April 2nd, we had the tariffs, really big tariffs being announced, and markets went into a panic mode, basically pricing in decoupling, right? Pricing in trade decoupling. And we know that global trade and supply chains, they took decades to get to where they are right now. It cannot be rewired just very quickly. It cannot be rewired from one day to the next without significant consequences to, critical access to critical goods, even just access to basic goods on the shelf, right? Without significant impact on inflation. So if markets were pricing in something that's just not possible, the speedy decoupling and rewiring of global supply chain, then that's something that we would be confident to lean against, even if we don't know the longer term landing spot. And this is why being risk on immediately after April 2nd has been a very good strategy so far. And equally for bond market, if markets are pricing in significant kind of restructuring of the demand for government bond issuance in the US, and we know that the feedback loop from government bond yields to policy decision is very much there, then there is something to be looked at from a tactical perspective as well. Now, looking ahead, I would observe that like right now we're experiencing this data is weak, especially labor data in the US is weak, and that supports more rate cuts, and markets are kind of pricing in more rate cuts. And that was very much behind why we are kind of finishing the year quite strongly, on top of AI development, of course. The Fed kind of being supportive of risk sentiment is a big reason. But if we were to stretch out a little bit through the course of the entire 2026, we're talking about tariff impact potentially feeding through to inflation. We're talking about some of the constraints on the supply side in the face of significant build-out demand also starting to bind. Inflation is not going to go back to pre-pandemic levels. Then I think it's fair to expect rates not going to go back to the very low levels that we came from. So there is, again, some disconnect that we can take advantage of as well.
Got you. And I guess, how should I think about the weighting of that, short term or very short term tactical view around in the US and markets pricing rate cuts, or and then maybe the 6 to 12 month view that actually inflation, whether imported, by tariffs or because of AI build out. I guess, how should I think about those scenarios, or balancing or weighting both of those potential outcomes?
Yeah, I think it means that in terms of risk budgeting between the near-term horizon, tactical horizon, and the strategic horizon, perhaps the risk budgeting needs to be weighed more towards the near-term and the tactical horizon, because that's where we have greater conviction, right? Like over the longer term, we know that inflationary pressure would bind. We also know that fiscal concerns would bind, and that's not just a U.S. phenomenon. Like UK, European countries struggling with how to make kind of fiscal numbers add up to support growth on the one hand, but also kind of making sure that bond markets don't panic about the fiscal spend. So that's a DM kind of phenomenon, right? So we don't know when exactly that would come into binding markets, but we do know that it's something that markets would have to react to. So in the near term, we can lean into Fed cutting momentum and all of that, but and this is where we currently have our tactical views focused on. But over the longer term, 5 to 10 year horizon, the views on government bonds are more negative, because we expect fiscal considerations to push long end yield higher, and the technical term is term premium, which is the additional return investors demand above risk-free rate, and the greater fiscal strain, the higher term premium needs to be. It's already come back quite a bit from the pre-pandemic negative territory, which was very hard to justify. But there's more room for that to push higher, because governments worldwide, across DM certainly, are having to spend more to support the transformations happening.
Okay, got you. And I guess if I take all of that and tie it into where we started this conversation around the macro isn't our parents' macro, so to speak. Something I've heard you say is referring to, is taking a risk with no macro anchor, which sounds terrifying to me as an investor, because we all want to anchor to something, I guess. But you're arguing that's an opportunity. So feels paradoxical, that having no anchor as a baseline is an opportunity, but maybe we can spend a bit of time on explaining that paradox.
Yeah, so taking risks with no macro anchor is just the first half of that sentence. The second half is that we believe mega forces are the new anchor rather than the typical macro playbook, right? So as I said, we are not sure if we are really going to be heading towards a continuation of the 2% growth trend. We could be going higher because of productivity boost. We're also not sure that inflation would be where it has been trending because of supply constraint. It could go higher. So macro anchors are less reliable in this environment of transformation against supply constraint. But we also do know that driving those constraints are the mega forces. So we view what's happening a lot more through the megaforce lens, rather than the typical cyclical ebbs and the flow, the typical business cycle, the typical macro cycle. Another way to look at it is, as we think about generating alpha for portfolios, in the past, you could take big macro calls, and that has allowed many investors to stay invested in bond market, and in decades, the 4 decades of yield compression, that has really been the right trade. So making big macro calls in the past has been very, very rewarding. But now there are other ways to generate alpha, to create additional value for portfolios that we want to lean into a little bit more. You look at positioning for regulatory direction of travel, playing around kind of liquidity provision during markets or volatility, thinking about being more granular, being more tactical, thinking through alpha strategy through relative value, being a lot more selective is one way. And our study shows that actually in this new regime, and we believe that we entered the new regime about 4 years ago, in this new regime, actually good performing strategies deliver more alpha compared to the period where rising tide was lifting all boats and it was harder to generate alpha. So this is really an environment where being active, being dynamic, and being more selective pays off more than before. And this is how we want to think about risk taking without macro anchor. So it may sound terrifying at first look, but there are plenty of other things that we can think about to construct a more dynamic portfolio in this environment.
Okay, got you. And you mentioned, mega forces and maybe looking for opportunities there, I guess. And, if I was being cynical, how do I find those opportunities in mega forces? How do I find alpha in mega forces without, ending up in, let's take AI, for example. I'd end up in the same crowded trade, big tech stocks as everyone else, presumably. So what's the approach there to finding alpha?
I think tracking the progress of AI revolution, understanding which phase we are in, and also understanding what's priced in is key in not blindly going into crowded exposures and being somewhat kind of differentiated in implementation, right? So right now we believe that we're still in the build out phase. So there is the build out phase, there is the adoption phase, which is phase 2, and then the third phase is where we see general productivity boost on an economic wide basis, which can take time. So right now we're in a build out phase, but not only that, on a more granular level, we're in a build out phase where capital intensity is increasing, right? So for a long time, a lot of this capex spending has been funded out of high cash piles of these big hyperscalers. They had huge amount of cash, free cash flow, and also operating cash flow. So they could fund a lot of the spend just because of the revenues they're generating. But the numbers are so big right now that they are now having to tap into the bond market. They're having to leverage up. So that's a different type of dynamics, right? Because as capital intensity increases, return on investment and also your assumption on internal rate of return needs to reflect the greater capital intensity. So being nuanced about kind of where we are in the phase is how we can be more selective, playing the mega force theme. Another way to think about it is, like to justify all this big spend by hyperscalers we talked about from a top-down macro perspective, growth needs to break out from the 2% long-term growth trend that has held up the last 150 years, including through previous industrial revolutions. So it's really hard to break out. But we now see possibility of that happening because there is possibility for self-enforcing innovation to take hold. So that's possible. But even then, it's not clear that the additional revenues generated would be accruing on the side of the builders. Because if you're building out excess capacity, then maybe the application layer is going to accrue the additional revenue being generated. All of that just to say, it's not straightforward that if you believe in the technology, these are the implementation strategy, because there are lots of assumptions that need to be made to land in a certain way, right? So if you think about, big tech right now, size matters a lot because they're starting from very healthy kind of cash buffer. So, having a very healthy kind of cash pile and balance sheet matters a lot. And there is maybe a bit of a kind of size gravitating towards kind of big names, right? Like there is oligopolistic kind of players having an advantage, and it has been a somewhat concentrated kind of play. But as adoption of AI broadens out from the typical sectors, for example, let's take it towards kind of pharmaceutical sectors. If you apply AI to drug discovery, who is going to capture the additional revenues generated? Is it the big pharma or the big tech? All of that just to say it's not obvious, right? You got to have to, it's not straightforward. So to say that, like if you believe in technology, then the implementation basket is clearly too crowded. I think that's a quantum leap that I think we need to kind of really map out and be thoughtful about the decisions and assumptions that we're making. And also all of that just to say, being selective is key. It's not super, it's not a rising tide lifting all boats. You talk about AI winners. I think that the relative value of winners versus losers may well generate more opportunities. So, like just to give a flavor of how nuanced some of these assumptions are, and it's not clear to me, the crowded are really that crowded once you apply that lens.
Okay, that's very fair. I mean, tell me if I'm completely barking up the wrong tree here. I guess I'm wondering whether there are parallels or lessons with, if I rewind a few years, the energy transition and people being very positive about the long-term implications in the short term, a little bit like how AI will be transformative over decades, but everyone's excited about next year's EPS or what have you. And maybe there's a similar dynamic around capital going in, but return on invested capital perhaps underperforming or undershooting. And again, from where we sit now, there's still an attractive road ahead potentially, but it's perhaps not as quick or fashionable as it was. So I guess when I think about that, with the energy transition, I've got that same sort of question about who actually benefits, where does the economics land? Is it with the energy firms or the building firms or company X that can take advantage of the lower energy costs? I mean, am I sort of fever dreaming here, or is there a parallel from both an opportunity but also a risk point of view there as well?
I think time horizon absolutely matters, especially when we're talking about structural forces, mega forces, right? So the low carbon transition is one of the 5 mega forces that we have identified, and AI revolution is the other mega forces that we have identified. So drawing parallels between the two is I would say fair enough, and I also think that but in the sense that they're all structural forces that would take a long time to play out. So, and I think it's also fair to say that with big structural spending commitment, the spending is front loaded, and the revenue generation could be happening later down the line. So when it comes to kind of being selective about investing, focusing on companies with strong fundamentals that can weather the gap between like when you spend and also when it starts to pay off is important, right? Like, so, as we think about the companies that could potentially be the ultimate winners of these revolutions, we focus on free cash flow. Yes, we look at earnings, and we also look at kind of the promises of the use cases and all of that, but they gotta have enough cash to tie themselves to when things starts to pay out. So free cash flows of companies, but also of their consumers, because their end customers need to have enough cash flows to keep the whole thing going. So these are I would say, signposts as we evolve our conviction in these mega forces. The ultimate, the core may be right, but you also need to be kind of navigating every step of the way to get there. So the cash flow dynamics of individual companies are very critical in us navigating the tactical and the strategic.
Okay, fantastic. So switching gears a little bit, and I want to maybe bring in the question asked by Anthony Y. So thank you, Anthony, for your question. But it's probably the $1 million question, which is asset allocation. As we look forward to 2026, how should we be thinking about asset allocation?
I think we have to be more dynamic compared to the old regime, because we're going to receive information around AI transformation that gives us clarity of the ultimate kind of landing spot. Right now, we're painting this picture of unprecedented wide range of outcomes on the table. It's very wide, both in terms of impact on growth and impact on inflation, impact on earnings potential and all of that. But we're going to receive information in the coming month, quarters, years that allow us to narrow this wide range of outcome. So we cannot set a portfolio and let it drift, thinking that it will be future proof. By definition of the period of transformation, nothing can be future proof. You may get lucky that what you have right now ended up working, but it's very different from future proof portfolios. So I think even strategic allocations need to be more dynamic to react to incoming information that allow us to adjust higher or adjust lower of the really ultimate scope of these transformations, right? We're talking about, some estimates are looking at 8 trillion of capex spent. But do we really manage to get there? And then that's constrained on the financing side, right? But what about constraints coming from physical side, constraints coming from energy side? Do we have enough grid permitting, all of that to really support the build out of such lofty ambitions? So maybe instead of spending 8 trillion, we end up spending like 70% of that, or maybe even lower, or maybe even higher. So we're going to get a lot of information in the coming month and quarters, and maybe even years, clarity, where we're going to really get a sense of ultimately how much we're talking about and how much of that can translate into growth and how much of that can translate into company profitability. So got to be open-minded to coming information, and really be very, very clear about our signposts, and when things move, be ready to move with that.
That space point in terms of where the space is for, like $8 trillion
and that's
worth of CapEx,
our like estimate of literature across the street, right? Like these are numbers that are being talked about. So like what does it take to really fulfill those numbers is the sort of kind of framework that we use to really size the potential of what we're looking at.
I mean, it would perhaps everybody watching now will have heard Cathie Wood yesterday talk about the potential data centers to shrink in the next year. And, if we could shrink the data centers, then maybe we don't need the space of, 10 Manhattans or what have you. Maybe we can put all the infrastructure we need in 3 Manhattans. And then it's, again, just to that point on signposting and tracking how viable these things are, how possible these things are. I'd love to spend a little bit of time before we wrap on risks, and maybe thinking about risks in a slightly different way, which is to ask you, what do you think investors are worried about way too much? And in reality, it's probably not as big a risk as they think it is right now.
Okay. I'm gonna say that the old playbook would look at what's happening in markets right now and really panic, right? Like valuation by some measures, if you look at Shiller PE, is very stretched. If you apply a mean revert type of playbook, then you'll be like, okay, this is not a good time to be owning these exposures. But I think if we apply a transformation playbook, appreciating that growth could break out in some scenarios from the 2% range that we have been stuck in for basically all the time that we know, the last 150 years, then maybe multiples can go higher, right? Like higher multiples can be supported. So all of that just to say, like the mean revert valuation concern needs to be contextualized in transformation. And that applies to equities, that applies to credit, that applies to many things, right? You look at credit spread, it's currently high yield IG, they are hovering around multi-decade lows. But fundamentals have changed a lot as well. You look at the US, for example. US government debt since pre-global financial crisis has basically doubled, whereas the corporate non-financials leverage has gone sideways. So in a way, it actually supports why yields are higher, but credit spreads are lower because fundamentals have changed as well. So I think just automatically applying mean revert when it comes to valuations is something I would caution against at times of transformation. It worked very well in a old mean revert type of environment where market activity. Yeah.
Cool. Okay, so I wonder if, and tell me if you think differently. It feels like the actionable takeaway, if someone is sat here listening to our conversation, and certainly for me, the one thing I'm going to go away and do is throw the anchors away. because perhaps that's the most important mindset shift or action to unlock opportunities in 2026. Is there anything else I should be taking away?
Yeah, throw the old anchors away, but onboard some new anchors.
Okay.
You gotta have
New
a
anchors.
framework. You gotta have a framework.
Yeah.
So basically adopt the megaforce lens rather than the typical business cycle lens as we digest incoming information, be it macro data releases or be it earnings, right? Like we have been in this super cycle of AI for a while. Typically, you look at the duration of bull markets, you're like, wow, like this has really been running on for a long time. But if you think about it through a megaforce transformation super cycle lens, you're like, well, we're just still in the early stages. We're still in build out stage. Build out is just getting levered up, and cash buffer is so high that it's not even that stretched in terms of leverage. So there's more to go. So I think applying that lens, all of a sudden things don't look as unsustainable as a traditional lens would apply. So just like evolve your anchor rather than throw away your anchors.
Okay, evolve my anchor. That is a wise word of wisdom to end this conversation on. So Wei Li, thank you very much.
Thank you so much for having me.